And Adrian, over to you.
Thank you, Si, and good afternoon, everybody. Welcome to our budget briefing. I'm just going to set the scene with a few slides looking at the context of Wednesday's presentation. And then James is going to take you through a bit of the detail around the key measures that are probably going to impact and be of most interest to people on this call, so the changes to the corporate tax regime. And then James is going to hand back to me, and I'll just talk you through a couple of bits and pieces that came out towards the end of the presentation that I think are still of potentially particular relevance to the corporate audience we're talking to today. So at the very beginning of Mr. Sunak's speech on Wednesday, he talked about these three key areas, three key objectives. He talked about protecting livelihoods and jobs, fixing the public finances, and building the economy for the future. Now, what we've done there on the first slide is just trying to tease out, almost like to translate what he actually means there. So what are the particular measures that deal with the particular issues? So when he talks about protecting livelihoods and jobs, the obvious measures are the extension to the furlough scheme, the extension to the self-employed income support scheme, and also the additional funding, so through grants and through loans through the two new schemes, which we'll come on to. When he was talking about fixing the public finances, I think it's fairly clear that there what he's talking about is tax rises, both explicit, so when we talk about the corporation tax increase in a moment, and also the implicit rises which come with such things as freezing of personal allowances. And then when he talked about the building the economy for the future, this is very interesting, I thought. There's a significant suite of measures in there to enable businesses to invest into capital expenditure, generally into capital expenditure and into infrastructure. So some very interesting measures there. Slide over the page, please. Just to put, again, a bit of context around the economic reality of where we are. The total fiscal support between the start of the pandemic back in March last year and 2022, so the middle of next year, we're looking at £400 billion, 400,000 million pounds. So that's a significant number. Government borrowing is expected to peak at nearly 100% of GDP before it stabilises at mid-high 90s. And then around 700,000 jobs have been lost. And I think we need to have in the back of our mind, those jobs have been lost even with the furlough scheme in place. So the question, I think, in my mind particularly, is when the furlough is withdrawn as it needs to be, as it must be at some stage, what happens to those, that unemployment level? Is that artificially depressed by the fact that a lot of jobs are being maintained, almost like zombie jobs, if you like, are being maintained through the furlough? And will a number of people drop onto the unemployment lists? We'll have to wait and see. I think the long and short of that is that the economy has shrunk by around 10% over the last 12 months. So, but Mr. Sunak was very keen to talk about some green shoots of recovery. The first one he was very clear to make early doors was that the economic recovery is already expected to be swifter than was originally anticipated by the Office for Budget Responsibility, the OBR. Unemployment is now at 6.5%, and the worst case prediction scenario from the OBR was 11.9%. So that's a significant improvement as against the worst case scenario, and which in turn means there are something like 1.5 million more people in work than anticipated. Although, again, let's bear in mind the impact of furlough on that and what happens when furlough ceases. And then ultimately, the economy is expected to return to pre-COVID levels by mid-2022. So if we unpackage that slightly and say, well, what does that mean? If we say the economy shrunk by 10%, but we expect to be back at that 10% increase by mid-2022, what that means to me is the next 18 months should hopefully be a period of significant growth. And obviously we as employers and as businesses in the area hopefully can be part of that. You know, we can help lead in that recovery. We can hopefully benefit from that economic recovery as it happens. So over the page, please. So James is going to talk you through the detail of these, but I just wanted to give you the headline of the eight or so key measures that were mentioned on Wednesday. The first one, and the most obvious one, was the increase in the corporation tax rate from 19% to 25%. There was a collective sharp intake of breath when that was announced, because I think everybody, myself included, was predicting some kind of increase I think the 6% increase is significantly more than I was expecting. I was expecting it to be stepped, which it is to an extent with this kind of marginal relief between £50,000 profit and £250,000 profit, but still it's a significant increase. My question there is, that puts us back into the realm of our immediate geographical competitors. So the Netherlands, France, the Germans of this world. I think Mr. Sunak was clear to say that we're still more competitive than our G7, the G7 family. But if you put this in the context of where we are geographically, we are now no longer, we cannot differentiate ourselves from the likes of Netherlands and Ireland, particularly not on a corporation tax rate. So the question is for me, does that make us more or less competitive as a destination for inbound investment? The 130% super deduction for capital allowances on qualifying plant and machinery, again, a very interesting positive development. And the 3-year loss carryback for corporate losses hopefully should enable a number of businesses to trigger corporation tax refunds over the last few years. So that was the top billing, if you like. The next up, the 5 or so measures which also got a fair bit of attention. The freezing of personal allowances until 2026. That, have no doubt, that is a significant revenue raiser for the government, because it's in effect the same as increasing the rate, but it enables the government to say they haven't increased the rates, but they've added a degree of more people get, as James will explain in a minute, more people falling within tax. The 5% rate for reduced rate on VAT for hospitality extended by another 6 months and won't climb back to the standard 20% for another year or so. So I think that's a very positive shot in the arm for that particular industry. As we said at the top of the presentation today, 6-month extension to furlough and self-employed schemes, again very positive for employees. New source of funding for businesses, so restart grants and the recovery loan scheme, both new schemes that can work in conjunction with the existing schemes. And then finally, one thing that was mentioned midway through but only got a very brief billing on the day was the increase in the national minimum wage from £8.72 to £8.91 per hour from April. Now, I think we as employers, as corporate bodies, will appreciate that that's obviously very good for employees and for employee welfare, but clearly there's a cost impact to us as employers when you bear in mind that there's not just the increase in the national minimum wage, but inevitably there's a degree of wage inflation as people move up there, the people above them move up as well. So it puts wage inflation into the whole business, and there's clearly a cost implication to that. So that's the headlines. I'll pass over to James, who's going to talk you through the detail.
Thanks, Adrian. So I think without doubt, the most high profile of the tax changes mentioned by the Chancellor on Wednesday was the increase in the corporation tax from the current rate of 19% to a revised rate of 25%. So really quite a substantial increase. Fortunately, this increase isn't going to be effective immediately, and it's not going to be effective until it was going to commence on the 1st of April 2023 onwards. I think it's worth stepping back and putting this in perspective, really, that this is the first increase in the main rate of corporation tax for 47 years since Dennis Healey, as a Labour Chancellor, put the rates up from 40% to 52%. So when I started in tax in 2000, the corporation tax rate, the main rate was 30%, and over the last 20 years, that has reduced steadily to where we are now, 19%. It's uber competitive, really, very low, historically low in the UK, I think, corporation tax rate. And this measure by the Chancellor is expected to raise him approximately £48 billion by the end of April 26. So a substantial recoup of monies here for him. It doesn't apply to everybody. It's only going to apply to companies that have taxable profits in excess of £250,000. And if you have profits of £50,000 or lower, the current rate of 19% is going to continue. Should you fall in between those two thresholds, profits between 50 and 250,000, they're going to be subject to a hybrid rate, not yet published, but the mechanics of that will be similar to how it used to be when we had different tax rates, and there was a type of marginal rate calculation that happened in your corporation tax computation. Again, worth pointing out that this is the first time since 2014 where the corporation tax rate has differed depending on the level of taxable profits you've had. So me and many other tax advisors have had it easy, I suppose, for 7 years with a flat rate of 19%, and we're going to work for our money now. There's a lot more to consider. Well worth noting that these new thresholds, they apply to a standalone company. So if we have associated companies or group companies, we're going to need to divide these thresholds by the number of associated companies. For these purposes, companies are going to be associated if one company is under control of, if one company has control of another, or both companies are under control of the same person or group of persons. Also worth noting that if you do have a corporate group and you have any dormant companies within that group, we can almost certainly discard those for the purposes of working out how many companies we need to divide these thresholds by. Dormant companies can receive dividends and pay dividends out without making them active for these purposes. Sometimes they can even receive a moderately small amount of bank interest as long as there's no other activity. Not on my slide here is the issue this might create with deferred tax. If you have a company that has a relatively substantial deferred tax provision, currently at 19%, this step up in rate to 25% is going to have quite a material impact on provisions. And it might be, depending on how these timing differences are expected to reverse, you might actually need to start providing on some of that at 25% a little bit sooner than you might otherwise have anticipated. So it's an important thing to look out for there. Si, next slide, please. So some welcome support to go against that tough news of the corporation tax rate increase. The welcome news being the Chancellor relaxed the loss relief carryback rules, and he's given us a temporary extension to enable us to carry them back for a longer period. The current situation was you could carry back a loss from one accounting period to the previous period without any restriction at all on how many losses you could carry back. But you could only go back 1 year. Now, under the Chancellor's temporary extension that he announced on Wednesday, this carryback period has been extended to 3 years. So certainly might be many cases where there's scope to carry back losses further, recoup more repayments of corporation tax. This extension comes with a couple of restrictions, although the first one here is more of a de minimis, whereby you can carry back up to £200,000 worth of losses beyond your normal 1 year period into your second and third period without any group limitations. However, overall in a group position, you will be restricted to carrying back surplus losses of 2 million, even if you've got 10 million, say, that you could have carried back. They're only going to let you carry back a surplus of 2 million with the excess being carried forward. The mechanics of how this would work is you would typically do your usual loss carryback to the previous year completely as normal and without restriction. If you still have losses left after doing the 1 year carryback, you would then look to the earlier 2 periods and see if you've got scope to carry it back to those periods. But when you start getting into those earlier periods, that's where your £2 million cap comes in. There's a couple of interesting points here on this loss relief in the small print of the guidance that's been published. Firstly, typically to surrender a loss to the previous year, you have to make your loss relief claim through your corporation tax return, and you need your tax return signed and signed accounts to submit that. And that will continue to be the case, except for claims to carry back losses below this £200,000 de minimis threshold. The guidance is that you're going to be able to make that loss relief claim outside of a tax return. They've not said how you will do it. I can't imagine it's as simple as phoning up HMRC and telling them you want to do it, but it does look like there's going to be a simplified mechanism to carry back smaller amounts. And rather bizarrely, although there is this 2 million cap as to how much you can carry back to the earlier years, and that applies across the group, the guidance says that this group cap will not apply if all companies in the group are only able to make de minimis claims. So it looks like you could have 20 companies in a group, each that only have losses up to, say, 195,000. And all of those companies could carry those back, and you wouldn't be restricted to this 2 million overall group cap. I think you'd have to go to sort of contrive your profits to get around the cap in this way, but I guess that's probably what they're thinking. It's too much effort to fudge, if you like, for want of a better word, profits between group companies to try and take advantage of this de minimis threshold. If I move slide aside to the next one, and the Chancellor he made a big deal about his super deduction for investment costs. And what he means by that is capital allowances for costs, fixed asset additions on plant and machinery. If we look at the current position for capital allowances, what you're entitled to do is you can claim 100% capital allowances, which is called your annual investment allowance, for any capital expenditure on plant and machinery, although that is subject to a £1 million threshold up to the end of December 21. We think that this relief is still going to continue, but it will revert back to most likely its earlier lower threshold of 200,000. And then typically, if you had spend of more than £1 million, you've used up your annual investment allowance. Additions in excess of that only qualify for a more miserly 18% writing down allowances for capital allowances. So what the Chancellor announced on Wednesday was this new super deduction. The super deduction being 130% deduction for expenditure on qualifying plant and machinery. So that's plant and machinery basically that would have typically gone into your general pool for capital allowances. This super deduction will apply for expenditure incurred between the 1st of April 21 and the 31st of March 23. And probably the most significant thing about the super deduction is there's absolutely no cap on this. So you could be spending absolutely millions and millions, no cap on this. You'll get 130% on all of it, in contrast to your annual investment allowance where we were capped at £1 million. Like sort of alluded to there, there's going to be some overlap here with this super deduction of 130% and your annual investment allowance. We think annual investment allowance is still going to continue in the background. But to be honest, given the super deduction, the only time you're going to use it is when you have capital expenditure that didn't qualify for your general pool of assets and instead went to the third bullet point, the special rate pool of assets. This is for things like integral features like wiring, air conditioning systems, heating systems, that sort of thing. So we would typically try and use what's left of any annual investment allowance on this expenditure. And under current rules, once we have exhausted that, we are stuck with a very miserly 6% writing down allowance. So it takes forever and a day to get full relief for that expenditure. So the Chancellor announced a new 50% first year allowance for special rate pool items. So certainly in this first 9-month period, whilst there's going to be overlap of super-deduction and annual investment allowance, you'll only need to use this 50% first year allowance if your spend exceeds your annual investment threshold. So perhaps the 50% first year allowance is not quite as generous as it might first seem. If we look at dates, it's well worth noting, under the super deduction there, it says that super deduction applies to expenditure up to the 31st of March 23, at which point we're going to have a really sort of hard cut-off point and a hit, because at that same time, we're no longer going to be eligible to claim this 130% super deduction. The very next day, corporation tax rates go up to 25%. So it's really quite a hard line in the sand there, and worth looking out for and being aware of. Si, could we go on to the next slide? Thank you. R&D tax relief. Fortunately, there were no real changes announced on Wednesday. What the Chancellor did do, however, is announce or make reference to an R&D consultation document that's come out. In that consultation document, it says that the government aims to raise total investment in R&D to 2.4% of UK GDP by 2027. And they do see the very generous R&D tax reliefs as having a key role in helping them to achieve that objective. The R&D tax reliefs are very generous as they stand at the moment. So the aims of this consultation document that's just been published, and it's out there for companies, company owners and advisors like ourselves to comment, is the aim is to ensure the relief is still up to date, it's competitive with other countries, and it's well targeted at those who really do deserve some relief for the development work that they're carrying out. The consultation document is asking questions like, what costs should qualify? Should any costs that currently qualify be omitted in future because they're no longer quite as relevant? And should some costs that don't currently qualify, should they be brought in the qualifying net? There's currently 2 schemes in place. There's a small and medium-sized company scheme and a scheme for larger companies. The question being, should they be aligned to simplify the relief? Also, the definition of R&D. It's quite unwieldy, and it was last looked at more than 10 years ago, and times have changed since then. So they're considering, is that still fit for purpose? Does it need to be changed? What's not on the slide, because it didn't happen in the budget, but somebody mentioned it this morning's session, is it's already been announced that there is going to be an R&D cap on the amount of surrenderable R&D tax credit you can get. Now, this is an anti-avoidance measure, and it means if you are surrendering losses for an R&D tax repayment at 14.5%, your repayment of tax is going to be restricted to £20,000 plus 3 times the company's pay-as-you-earn and national insurance bill. This will not start taking effect well, it starts for accounting periods beginning 1st of April 21 onwards. So current periods will not be affected by this. Once your accounting periods start commencing 1st of April 21 onwards, they'll fall within this. However, we wouldn't expect that many clients to be caught by this because it's predominantly anti-avoidance legislation to stop companies that basically don't have much in the way of payroll cost whatsoever, allegedly outsourcing a lot of R&D costs and submitting substantial repayment claims. So it's really been put in place to stop these repayments where companies aren't really employing any staff in the UK, etc. Si, could we move on to the next one? Okay, tax rates and changes. So while there hasn't been any increase in tax rates, what the Chancellor did do is basically freeze almost all of the thresholds at existing levels, some small increases before they get frozen. But at least he was very open and about the effect that this would have and the fiscal drag effect of this, and that significantly more people will be brought into the tax net here. It is said that freezing the allowances, which I'll come to in a minute, will bring in £8 billion more per year when compared to increasing the thresholds in line with inflation. So a huge increase in tax take. And over 4 years, it is expected that freezing the rates and thresholds will bring 1.3 million people more, 1.3 million more people into the tax system at the lower end than are currently in it. And it will also create 1 million more higher rate taxpayers. So a substantial amount of fiscal drag going on here without any headline increases to rates. So personal allowance is currently 12,500. A very modest increase had already been announced to 12,570. That's going ahead from the 6th of April, as is the increase in the higher rate threshold up to 50,270. However, from there on, those thresholds are frozen until April 26. Relatively similar thing in capital gains tax, to be honest. The annual exempt amount of 12,300 is frozen. It's going to be frozen until 2026. But in reality, there was so much speculation about changes to capital gains tax. Will rates be aligned with income tax rates? Will some of the very valuable reliefs like business asset disposal relief, many other reliefs, and even your threshold there of 12,300, it was speculated that some of them will go, rates will be aligned with income tax, and there'd be a hard hit on capital gains tax because of the perception amongst the public that it's a tax that the rich pay. It's a very political move, but that escaped. We had quite a few clients hurriedly completing deals before the budget in case this happened, and it didn't happen. I think we would expect some sort of increase in the next autumn statement. So there's probably just a stay of execution here really before things really do change in capital gains tax. But for now, nothing's changed. Very similar inheritance tax wise, that nil rate band of 325,000, it's been frozen, it's remaining the same, and it's not moved since 2009-10, as you can see. So that's 11 years of same band. So although again no increase in rates over that 10-year period, there must be a significant amount more people falling within the inheritance tax net than there was previously. Si, next one please. A few more exemptions and tax rate ones here. Employees class 1 NIC threshold. That the rate at which we start paying national insurance at 12% has been increased by a very small amount of £68 up to £9,568. And the upper threshold, which is the level above which we see our national insurance contributions reduced to 2%, that threshold's gone up but to 50,570. So very modest increase. Those increases had already been announced prior to the budget. Once these modest increases come in, the new thresholds are then frozen until April 26. And pensions. Pensions, again, quite a soft target in the press for speculation of changes, reductions in the amount of contributions you'll be able to make and still get tax relief on. All that's happened is the lifetime allowance, which is the aggregate amount that can accrue tax-free in a pension scheme, has been frozen at the current level of just over 1.07 million. That was announced would stay the same until April 26. It had been expected to increase by just shy of £6,000 in line with the CPI, but that's not going ahead. Si, next one, please. So I noticed this one hidden away in the sort of small print of the budget document, the announcement that there's going to be a reform of the self-assessment penalty regime. So this is for income tax purposes, and the aim is to make the regime for penalties fairer and more consistent. I suspect the fairer and more consistent will increase the Chancellor's take from penalties, but given the benefit of the doubt, at the minute we have very sort of strict dates where if we miss filing dates or payment dates, penalties arise, flat rate penalties will arise, and late payment interest will arise. It's said that penalties will only be issued when, the regime is going to be more points-based, so it feels like there'll need to be one or two offences or compliance failures, should I say, before you get into a penalty position, and I hope that's how it will turn out, with penalties only being issued when a certain threshold is reached. It said penalties will be proportionate to the amount of tax owed and how late that tax is. So those failures where it's just a simple late tax return and the tax has been paid, hopefully they'll escape the flat rate penalties they currently get. We'll have to wait and see till there's more published on this. The new regime is scheduled to come in from the 6th of April 23 for taxpayers with self-employment or property income of over £10,000 a year, and from 6th of April 24 for all other taxpayers. We'll have to wait and see basically on this until more guidance is published. So next one, at this point I can hand you over to Adrian. Away you go, Adrian.
Thank you, James, thank you. So along with the R&D consultation, there's been a call for evidence around enterprise management incentive schemes. So for those of you who've not come across that before, the EMI scheme is a way in which businesses can give options over shares in the business to key employees with various hurdles for the staff or for the business to achieve before those options vest and the individuals get shares. So it's very heavily tax advantaged, and it's one of those rare beasts these days which is a statutory relief, but it's also tax advantaged. So there's no income tax for the beneficiary on receipt of the options, no income tax on the exercise of the options. The only tax that arises, assuming you do it correctly, is CGT on the ultimate disposal of the shares. Now, the reason that there's been a call for evidence because there's a question with HMRC about whether it's hitting the target it wants to hit. Is it efficient enough? Is it being encouraged? Is it encouraging the right behaviours? Are the right kinds of business using it? And anecdotally, we see that very often the EMI schemes do not actually end up with the shares being appointed to the individuals because for various reasons, often it's usually based around an ultimate exit from the business. So relatively rarely it seems that does it fulfill the aim of giving shareholders, the management, a stake in the business. So we're going to, there's a call for evidence. We'll be pulling together our ideas. So if anybody does have any things they want to feed into this, please do let us know, and we'll put it into our bundle of kind of evidence, or if you like, for the HMRC. So that's an additional consultation. So no fundamental changes announced, but there potentially will be somewhere down the track. Next slide, please, Sam. So when we started this presentation earlier, we talked about the three key areas that Mr. Sunak was looking to help with. When we look at protection of jobs and building the economy for the future, the Restart grant is one of those measures. So this is a grant that's available for businesses that have been required to close because of the lockdown. It's available for up to £6,000 per premises based on the rateable value, and it's available in the first instance to non-essential retail businesses. That level of £6,000 is trebled to £18,000 for hospitality, accommodation, leisure, personal care and gyms, simply because they've got a longer time until they can open, so they've got a longer period to bridge through the difficult times ahead. So there's a 3 times of the original 6K for that kind of business. So hopefully, if you do want any help navigating through that, please let us know, and we'll put you in touch with the team here. And the same with the recovery loans. This is an entirely new scheme, which is up and running from the 6th of April for businesses of all sizes, from amounts from anything between 25k and 10 million. Any business can apply, including those who already have, for example, taken CBILS loans. So it's in addition to the existing schemes funding available there. Government will underwrite 80% of the new loans, so another positive sharing the risk with the banks, and the finance is available over a period of between 3 and 6 years, to a maximum of 6 years. A couple of caveats: personal guarantees are required for loans when they're over 250,000, so that kind of pushes it slightly down the pecking order in terms of preferences, I think, if they are requiring personal guarantees. And also businesses must be able to show how they've been affected by the pandemic and that they remain solvent. So again, if you want to look at these with us, please let us know. I'm sure Nigel Barrett and the corporate finance team will be happy to help with that. So just a couple more slides. The first one on miscellaneous. So this captures everything else that didn't fall neatly to any of the previous categories. So as we've mentioned previously, the furlough scheme for employees has been extended for 6 months to the 30th of September. The difference being now is from July onwards, employers, so we in the room here, will be expected to start to share some of that 80% payment to the employees. At the moment, at 80%, unless businesses want to top it up to 100% of employees pre-COVID salaries, the government needs the full 80% of the salary. My question here, my slight concern here, is if businesses are already topping up their individuals up to 20%, and then they're up to 100%, and they're expected to then share in some of the additional 80%, that could potentially mean that it's either a significant greater cost to employers, or the employees end up getting just the 80% rather than the uplifted 100%. But again, that depends upon the individual circumstances of each employer, I think. The self-employed scheme, so the self-employed income support scheme, has likewise been extended by 6 months to the same date, 30th of September, and that gives an 80% payment, 80% of 3 months average trading profit, capped at 7,500. One thing that was barely mentioned, which I think is going to be a significant thing, is the IR35 off-payroll workers. The regulations, the changes are still now going ahead from April the 6th. There's no deferral there. I do think that's got the potential to cause headaches and disruption for business. And if you remember, if you've looked at this previously, you'll remember that the rules, in effect, flip the onus of reporting for contracted workers. At the moment, the individual contractors are required to self-assess their position as employees or as contractors, self-employed. Now that flips on its head, and now the business that's engaging the person, the contractor, has to make their own self-assessment as to whether that person should be on the payroll or shouldn't. So obviously there's a fairly significant administrative headache there, and also potential additional costs if those people are found to be, if we as a business, we self-assess these people as employees, we have employers' NI, national insurance contributions to worry about, as well as the administrative burden of putting them on payroll. A couple of other points. If any of you took advantage of the VAT deferral opportunities from COVID for the first 2 quarters of last year, the new payment scheme is now open. And that means that by the 30th of June this year, you need to have either joined the deferral payment scheme or paid the deferred VAT in full, or have made an alternative arrangement with HMRC, a time to pay arrangement. If you've not done any of those things, then there's a 5% penalty on the outstanding VAT. Obviously, that could be a significant number because the VAT payments tend to be fairly significant. So the simple answer is there, just make sure it's covered. There's 3 ways we can cover it. So let's make sure we're covered. Let's not leave it outstanding until the 30th of June and be hit by that penalty. And the final one on the miscellaneous is stamp duty land tax. The nil rate band of 500,000 for residential properties has been extended until the 30th of June, and then it tapers down again to the original 125 grand by the end of September. Again, only of tangential relevance to people here if you or family members are buying properties, but still an interesting point nonetheless. So, Si, on to the last slide. Slightly left field, but I thought it was worth mentioning because of the geography of it all. So the Chancellor mentioned 8 new freeports. There's 3 potentially in our area, very broad in the north: Teesside, Humber, Liverpool City region. These are going to be operational from late this year, and the idea is they are going to provide significant benefits and very generous tax reliefs, government support to businesses which physically set up in these territories. Just to give you a flavour of what the benefits potentially are, there's an enhanced capital allowance for buildings, so structures and buildings allowances. If any of you are old enough to remember industrial buildings allowances, IBAs, this is the kind of the son of IBAs, but it's significantly more generous. So it's quite a good relief. Bearing in mind at the minute, structures and buildings allowance gives you a pittance of allowance outside of the Freeport zone. There are also standard enhanced capital allowances, including 100% for qualifying activities. And the obvious question there is, going back to James's comments, is how does that interact with the new 130% super-deduction? Because I'd imagine the super-deduction is more, well, it is obviously more interesting than 100% deduction. So we'll have to see how that plays out. But clearly that's part of the suite of ideas for the Freeports. Another couple of very interesting ones: full relief from stamp duty land tax on the purchase of land or property. So that can be a significant, 5% of purchase price now knocked off. So it's a fantastic potential result if you are looking to invest in the area. Full business rates relief up until the 30th of September 2026. And perhaps the singular most important relief there, and one that's still only at a proposal stage, is full relief for employers' national insurance contributions for people employed in the Freeports. Bearing in mind that that's 13.8% of wage cost, that is potentially a very significant relief. I think it's still watch this space to see if that is confirmed. But if it is confirmed, I think that would be a particularly interesting relief. So that just gives you an idea that clearly that's somewhat left field, as I say, because logistically, we're not just going to pick our business up and move into Liverpool City region. But if we are looking to, if we've got some thoughts about where we might site our next project, our next factory, let's look at these seriously, because the reliefs there are genuinely significant. So, Si, that's all I wanted to say. Can I pass it back to you?
Yeah, thank you, Adrian. Thank you, James. I'll just stop the recording there, and